We're talking dividends on this technology edition of Industry Focus. Greetings, fools. I am Sean O'Reilly, joining you here from Fool headquarters in Alexandria, Virginia. It is Friday, November 20th, 2015, and joining me to talk dividends in the worst possible sector for them is the dependable Dylan Lewis.
I like dependable there. It kind of feeds well into
You see what I did there?
theme of dividends and reliable payers and showing up to do the show once a week.
And I was actually, I was saying that, and I actually realized I think the biotech sector would be worse.
That would
so
be
second
worse.
worst sector for dividend discussions.
But they're out there.
There are, yeah.
And, we'll get into
Apple's
them.
got one, yeah.
We might kind of like steal a couple companies from CG.
We'll try
a little bit to like kind of curb them into
buffer it a little bit.
us.
Yeah.
But excited to do the show.
So, all right. We're talking dividends because it's dividend week on Industry Focus, and we're a tech show. How are we going to pull this off? Are we just going to...
I was doing some research on this. I mean, you'd be surprised. There are a decent amount of tech, in dividend-worthy tech companies to discuss.
Do not lose heart, dear listener. We promise we will deliver.
Yep.
So before we dive in, we actually have a listener question that fits in perfectly with this week's theme.
Yes.
And what I assume it's John in Columbus, Ohio. Thanks for writing in, and go Bucks. I happen to be born and bred in Columbus, Ohio, and we moved to Cleveland when I was 13. So, John, thank you for the shout-out.
Sean was psyched to be getting
I was like, oh, my gosh. Columbus. I mean, there's a Columbus, Georgia, I think. But
yeah, I think you're
anyway.
right.
So, John writes, I have two questions. I am looking to start a dividend portfolio. I am 31, so I have plenty of time to build this up. My father, however, will be 60 soon, and he would like to transition to more dividend stocks for income in retirement. I'd like to help him build this portfolio and maybe mirror it with my own. How should we go about constructing one? Is it simple as just buying 5 to 10 good-paying companies in a brokerage account? Do you start out with many small positions or 1 to 2 large positions and add to them? We're probably going to have to refer back to this, but Dylan, thoughts?
Yeah, so a lot to answer there. Great
It's
question.
actually like 5, 6
and
questions.
It's
You
great 'cause,
cheated,
like,
John.
identifying dividends, portfolio construction, a lot to digest there. Constructing a portfolio, I think we should just start there. Is no small feat. And I think when I was thinking about how to answer this question best for our listener, I revisited...
Disclaimer, neither of us are
not
certified financial planners.
No,
We're two guys in a podcast.
But I revisited our 13 Steps to Investing Foolishly, which is on Fool.com. Excellent resource for people that are looking to get started or just kind of want a refresher on some things to keep in mind. Sometimes you kind of wind up down the road somewhere, realize that you are super overweight in one sector, or maybe you haven't been dollar cost averaging well, things like that. It's always nice to just kind of get a refresher on the basics. So I revisited that, and I found this great quote. You want to invest in sips, not gulps. And I think that is... Oh, and Sean is going for the coffee.
I took a sip,
Yes.
Dylan.
And you feel like you're comfortable taking it.
I am, yeah.
You're
Now
not scared that you took too much of a gulp.
I'm going to go invest in my 401k.
Yes.
In a sip.
And so this is a great way to think about adding to positions, creating positions, and starting out your portfolio. And I think there's a couple reasons for this as just kind of a guiding light. And one of the main ones is it's incredibly tough to time the market. And so if you are investing in gulps, so if you are buying very large positions in
today
in 1 or 2 companies, you are going to be hit by volatility at some point, or you are going to buy on a very up day. And so I think one of the maybe it was a Morgan Housel tweet or something like that I saw a little while back was like, figure out what you want to buy, commit to a schedule to buying it unless the investing thesis changes, basically. And it's like, you'll add to the position over a period of 4 months, 5 months, and you will regularly buy into it. And so that's one way to kind of mitigate against some of that timing the market risk, because none of us can do it, right? I mean, like, you might look at like, oh, it looks oversold today, it's a good time to buy, something like that. But if you're long-term oriented, like, that kind of stuff shouldn't matter. And it's better to work towards a better dollar cost average, over the course of kind of a medium-term amount of time, I think. Another reason that I think this is a great way to think about investing is you're going to be wrong a lot. So if you are investing in sips rather than gulps, I think you start to learn quite a bit more about a company after you invest in them, unfortunately. Like, this is something that I've found, at least. I don't know about you.
Well, yeah, and even Warren Buffett, when he, I read this awesome thing one time, and it wasn't in an annual report, but he said that whenever he is interested in a company, like, a couple of years ago, he's been buying into, I'm going to plug a tech name, IBM. Yeah. When he was, curious about IBM 4 or 5 years ago, I'm sure, he did this. He buys a couple hundred shares of the company. They'll send him the annual report. And by buying just a small, tiny little stake, it actually triggers something in your mind to where, oh, I actually have money in this. I should probably look into it more.
Right.
So, again, even Buffett sips.
Yeah, and that's actually another point that they draw in 13 Steps to Investing Foolishly is buy one share to start. If you've never bought any stock before, buy one share in a company, and you'll realize that you are now paying attention. Obviously, if you're looking to build out a portfolio, maybe you start to do that at a little bit of a larger scale. But I think just kind of a case in point as to why you're going to be wrong a lot. In my personal portfolio, if you were to look at just like binary up or down, I'm down in like 40% of my positions. Granted, like I'm very like tech centric, but like my winners have proven out, and overall I'm up. But if I were to have only invested in 2 companies,
right,
I might be looking at like negative portfolio returns. So kind of to your question about, is it better to buy 5 to 10 good companies or build large positions of 1 to 2? I would go with the 5 to 10 and slowly build out larger positions in each of them rather than be highly concentrated in 2 companies.
Well, not only that, but John, both you and your dad have nothing but time. He is only 60. In America, the life expectancy is above 80. You're 31. You have you have plenty of time to do this.
Yeah. I will say there are 2 things that are going to tempt you away from this line of thinking, and I think it's good to just kind of air them out now so that you're aware of them, and maybe you won't be as as biased by them when it's time to actually make moves in your portfolio. One of them is transaction fees, and I know it's just something that kind of creeps into my mind is like, well, all right, if I'm ultimately looking to invest like $2,000 in a company or something like that,
and I buy 10 positions, and it's $10 commission each time. That's $100.
Yeah, it adds up. So, you're like, oh, well, I can just buy once and, have a much lower transaction cost as a percentage of what I own. Again, like long-term, so is that 1% or whatever really going to matter all that much over the course of years of compounding, whether it's dividend income or stock price appreciation? No. Yeah,
especially if you're buying like 1 position per month or whatever you're doing. Like transaction costs are important, and the best investors in the world talk about them a lot. But it's actually they're framing it in reference to not day trade, not long-term slow position building.
Yeah. So don't worry too much about that. I think as long as it is not eating up a humongous chunk of your actual transactions, then it's not really something to be too much worried about. And also, I think it's always tempting to want to see immediate returns and hit scale, and the easiest way to do that is to buy a lot at once. But again, knowing that you will be wrong some of the time, and the market will take weird downturns because of macroeconomic factors,
right? Or
something like the retail industry getting hit really bad, which we saw last week. Were you to be buying ahead of something like that, you'd be in a rough position, right? So I think that those are just some good things to keep in mind with respect to that question.
So Dylan, are there any good books for John and his dad to read about dividend investing? I had one in mind, but anyway.
One of the things that we talked about kind of prior to doing the show was, so dividend investing, there are some unique elements to it, but really like you're looking for good companies, right? I mean, everything that you would buy from a dividend company or anything you look for in a dividend company is something you'd want in a regular company, more or less.
Right.
It's just that maybe the growth profile is a little bit lesser, And so I'd say really anything that is basic stock focused that is not super growth oriented can probably serve as a pretty good intro or guiding light for dividend investing. What about you?
Yeah, so I actually did a search, top dividend stock books.
Yeah.
And actually I found one that I like, dividend.
I know that there's also, I'm pretty sure, like the Little Book series on investing. I know there's a Little Book of dividend investing. That's a pretty excellent series. They're really quick to get through. So that's something that you might want to consider looking at. I haven't read that one personally, but I've read some of the other Little Books, and they've been really fantastic primers for getting into some different areas of investing that I'm not as comfortable with.
Dividends Still Don't Lie by Kelly Wright. It was a follow-up to the 1980s book, Dividends Don't Lie. And basically it relates to what we were talking about, which was, what you want in a good stock is what you want in a good dividend stock. Strong business model, growing, franchises, all that good stuff.
Mm-hmm. Cool. So I think one of the interesting things talking dividends was kind of what do each of us look for in dividends.
Right.
And
we're both young guys, though, so we don't think, I need dividends right now.
No, but I will say I'm trying to build out a larger portion of my portfolio that is dividend oriented, just so that I have that stability. You generally don't see huge swings with dividend stocks just because they tend to be a little bit more stable. a little bit more established in the sectors that they operate in.
Well, yeah, not only that, but history bears this out. The last 100 years, what percentage of total returns in the stock market came from dividends? It was like 40% of all your returns came from dividends or something. Yeah,
I didn't
just
know
something
that.
crazy. Yeah, and it's like, well, yeah, I mean, it's every American corporation all lumped in together. That might be true. Anyway,
Yeah.
So what do you look for, Dylan?
So I like three things as kind of like a quick checklist. I like operating in an industry with high barriers to entry. Not always something you're going to be able to find, but if you can, it kind of insulates you from some competitive pressure. It makes the next 5 to 10 years a little bit more foreseeable than if you're in an industry that's very easily disruptible.
Right.
So I think that's one thing to watch. Obviously, you want something that has available growth avenues, right? So just because there's been recent, great top line growth and consistent bottom line results doesn't mean that that's something that will continue unless they have a plan to, enter new markets or develop new products or something like that. So you want to see that while there's a strong core business, there are also elements that project out well for the next 5 to 10 years at least. And I think something that all dividend investors are very conscious of is the payout ratio. And so something that you want to just keep in mind is how much are they paying out as dividends, both as a proportion of net income and free cash flow, and is that something that is both sustainable and has room to grow? And so, if your primary reason for investing in a company is, you like the yield and, all of the things being equal, the business looks good, then are they going to be able to continue to grow that yield?
Right.
Yeah.
No, that's the trick.
So, those are the three things that I look at. What are you particularly mindful of?
I obviously can't argue with any of those points because they're spot on. The only thing I would look to add would be that I have two ways of looking at this, and it's basically just through the total return internal capital allocation point of view. And then the other thing would be just the I need income and retirement point of view. In order to make the latter happen, what needs to happen first is the corporation needs to be growing. They need to be doing well. The dividends should only be paid when there are literally no other rational uses for the cash. That's a little trickier in particular in our sector because even Google, they don't pay a dividend. They're trying to, start Alphabet or
and Google only recently announced that share buyback, which is a way to return capital to shareholders
like earth-shattering,
to a certain way, right? It's part of that capital allocation program and just that general philosophy. But buying back I think it was $5 billion worth of shares.
So small
is very different than paying a dividend because you are on the hook for that dividend consistently.
Right.
And I remember I saw this great quote. It was specific to tech companies and dividends. And they said, announcing that you're going to be paying a dividend is kind of like ditching your hoodie and jeans for like khakis and a button-up shirt.
Yeah.
And it's something that a lot of tech companies aren't willing to do.
They're paying a dividend. They're so square.
Yeah, man, they've sold out. So, and it's tough with tech because I think there's always this pressure to be growing pretty rapidly. And to your point about capital allocation, you don't see a lot of really gaudy dividend yields in the high growth tech area just because the businesses can better invest their money internally and provide better returns for shareholders that way.
Well, not only that, but in order to justify paying a dividend consistently, you need to not only prove that you can't use the money internally better to make an acquisition or something, but you also have to factor in the tax implications of paying out a dividend to shareholders. So there's a 15 to 30% tax, and had you just bought back shares, and then theoretically the value of each share would go up. There's that. I mean, you need to be really, really sure that is the best use for the money.
Mm-hmm. Yeah, that's a great point.
It's particularly difficult in our industry, but you'll notice the people that pay out huge chunks of their profits and free cash flow, what you're talking about, it's Altria, it's Procter & Gamble. These are enormous consumer brands that they've made it.
Yeah, and you mentioned IBM before. It's like this is someone that's been in the tech space for a really long time. They're very established.
They traded their khaki shorts for suits long ago.
yeah, quite a long time ago. So a lot of up and coming names in the tech space, really aren't a part of that conversation. That said, you look into the space like telecoms, things like that.
Right.
That's where you start to see some pretty attractive yields, and I think also a lot of elements of the business that check off some of the bullet points that we'd mentioned earlier.
For sure. Before we move on and going along with this week's income-focused theme, I wanted to point our listeners to a special article written by 5 industry-focused contributors, including yours truly and Dylan Lewis. with our top picks for dividend stocks. Just head to dividends.fool.com to learn our picks for the best dividend stocks for 2016. Once again, that's dividends.fool.com. And to make it easy on everybody, I will drop that in the iTunes description of this podcast. So, Dylan, before we head out of here, I did want to get your thoughts on what mistakes do dividend investors make and how they can avoid them.
Yeah, because I think dividend investing, you look quick and you're like, oh, like I just invest.
Oh, I got a 5% yield.
Yeah,
awesome.
Like, I'm going to be getting that every year, right? And like you just kind of factor that in as your rate of return if you're just doing like a quick, oh. So I think one of the big things people need to be cautious about is being yield centric. And kind of like we mentioned, you might be tempted to use a yield as your screener, right, when you're looking at dividend stocks or potential investments. And I think it's definitely a good place to start, particularly if that's your orientation. But it's something that you definitely need to dig deeper on. So some companies in the tech space, other sectors as well, have these very gaudy yields. But you need to read into why that's the case. Sometimes that's because there's been huge share price depreciation, and so
which implies some sort of trouble.
Yeah, and so it's easy for a percentage to go up when the denominator goes down, right? And so just as an example, I think Seagate's dividend yield is like 7%. In the past year, the stock has lost half its value. So that is not necessarily a sustainable 7%.
That is not why you want that yield, yeah.
Right. And part of that is because the business is struggling. They've missed on reports recently on some of their quarterly filings. Customers seem to be moving a little bit more towards solid state drives than Seagate's flagship magnetic disk drives. So there are all these competitive and just business elements at play here that ultimately undermine, the long-term viability of that dividend and the yield that it currently is.
On the other end of the spectrum, you picked a couple of names that don't have that sky-high yield, but long-term...
Right, yeah. And so, again, only looking at yields might cause you to miss out on some of these kind of like best of both worlds growth stocks that also have, a nice little dividend as a kicker. And no one's going to be surprised to hear this name, but Apple, they make everything, and like they are a fantastic growth company. They have a great growth profile, and they have a nice little dividend yield. It's like 1.75%, something like that. And I don't think anyone's going to argue that company's not going anywhere. Like they're going to be around for a while.
Not only that, but the odds of them just upping that just a little bit for the next 1 to 2 decades, probably pretty good.
Yeah, and
that's really what somebody that's looking to build a long-term dividend portfolio, like John earlier, should be looking for. Something that's yielding 2 or 3% right now and is not guaranteed, but probably going to up it later.
Yeah, and it's something where you'll probably enjoy some very nice share price appreciation along the way.
Fingers crossed.
Because of those growth drivers. Yes, I'm a shareholder, so I hope so. And just another name, and kind of in the same vein, where if you're only looking at 3% above on yield, something like that, you'd miss somebody like American Tower. So they're an owner and operator of wireless and broadcast communication sites. They're in a couple
mildly
of
important today. Huge barriers to entry. Who has the money to build those stupid things?
Yeah, and they lease them out.
Yeah, boom.
And so huge barriers to entry, capital intensive business. And you look at the macro factors at play. Cell data is huge. It's going to become even bigger in the next decade. So they're well positioned for that. They only have a yield of like 1.85%. Like they're under 2%. So that's another great business that offers you some growth, also offers you a nice little income on the side, something you would overlook if you were just looking at yields. So I think that's just another thing to keep in mind.
Cool. Very good. Well, thanks for your thoughts, Dylan.
Always a pleasure, Sean.
Have a good one. And that is it for us, fools. If you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that is industryfocus@fool.com. And as always, people on this program may have interest in the stocks that they talk about, and the Motley Fool may have formal recommendations for or against those stocks, so don't buy or sell anything based solely on what you hear on this program. For Dylan Lewis, I'm Sean O'Reilly. Thanks for listening, and Fool on.